Thank you for coming and welcome everyone to our talk tonight on market uncertainty and strategies to protect and stabilize your client. So what are we going to discuss today? Well, we're going to talk a little bit about strategies to help manage volatility and adapt to changing markets, portfolio approaches aligned to your stage of investing, and planning opportunities for incorporated dentists to improve tax efficiency and access capital. Ways to reduce reliance on traditional fixed income and to protect a portion of your wealth. Now, let's do a couple of quick introductions here, and then we'll get started with Gino's presentation. For those of you that don't know me, my name is Michael Tyler. I am the local investment planning advisor located right here in Winnipeg, Manitoba. Been working with CDSPI for the last 9 years. And I'm going to turn it over to my colleague Gino from our asset management partners, Cumberland, to introduce himself. Go ahead, Gino.
Yeah, thanks, Mike. Good evening, everybody. Great to be here. We've got a big presence in Winnipeg, so looking forward to this presentation. I've been with Cumberland for the last 22 years as a portfolio manager and working exclusively with CDSPI. My team and I are dedicated to CDSPI and their dentist members. So looking forward to hopefully getting some good questions at the end of this.
You bet. Okay, so let's jump right into it, Gino, and I'll start with your first slide.
Great. So we're going to take you through some key points that should help you navigate the craziness we're seeing, frankly. And so most of your financial life has been about building, growing assets, taking calculated risks and leaning into opportunity. But at a certain point, the objective subtly changes. It becomes less about how fast you can grow and more about how well you can protect, stabilize, and access with what you've built. So we hope we can bring you a few key points to consider to help to take you through today's environment, stay focused, and really enjoy the journey. Let's go to the next slide. But finding stability today more than ever is becoming harder to navigate. What I'm hearing more and more about clients is not really panic, but uncertainty. Are we positioned correctly? Should I have done something earlier? Will this portfolio actually hold up when I need it? These are rational concerns in today's environment for sure, but they're being challenged today by the media feed. And let's look at the next slide. There is no question we're in one of the most confusing environments in years. On one hand, you've got strong earnings, resilient economics, you've got stable employment, and the consumer is out there spending. All of this is a recipe for stronger markets. And on the other hand, geopolitical tensions are causing havoc. You've got trade friction and questions around whether this massive spend in AI will actually pay off in the end. And all the while, markets are trying to reconcile both at the same time. That's actually the making of volatility. And let's look at the next slide. It's not a random ride, volatility today. It's structural, and the issues are real and should be cautionary, frankly. Geopolitical tensions are reshaping supply chains. Tariffs are creeping back into policy. And perhaps most interestingly, investors are starting to question whether the billions going into AI will translate into real returns at the end. The real risks you face today are personal, though. And whatever stage of life you happen to be in, we'll look at that in the next slide. As I said, the biggest risk is personal. It isn't missing the upside of what the market has to offer. It's the timing risk. A major drawdown right before you're ready for income can permanently impact your lifestyle. This is what we call sequence risk, and it becomes critical at the preservation stage. Yeah. That's because you're balancing growth and income with risk management as the overarching criteria. Time is essentially becoming more important for you. And while you're in the accumulation phase, you're young. You should be looking at nothing but growth. Your objective is to build your assets by saving regularly. You have lots of time, and dollar cost averaging is your friend. And you allow the magic of compounding to take over. In the transition stage, you've got money now. Preservation is starting to be important to you. So you're still working, so you're able to ride out volatility. Next slide, Mike. Thanks. And so what becomes imperative is to build structure around your portfolio. And it needs three things to work simultaneously. You've got to grow because inflation doesn't stop. You've got to protect that capital because volatility matters more now than ever. And you've got to provide access because flexibility is going to be everything during your retirement years. The degrees will differ depending on your stage in life, but let's take a look at that and what's that done. We go to the next slide. Thank you. So in your growth phase, regardless of whether you're in whatever investment cycle you happen to be in, growth still matters for the points I made earlier. But the type of growth matters more. We want businesses with pricing power, strong balance sheets, and consistent cash flow. No speculative growth, the durable growth. And we think high quality growth can further be enhanced through a more active selection process. Markets are dynamic, so why would you accept a passive strategy for your investments? And let's take a look at the next slide. By being more deliberate about your investments and truly owning best ideas while staying nimble while managing risk is the path to stable returns as far as we're concerned. In a straight line bull market, passive works really well, and we've seen that over the last decade. But in a fragmented, rotating, uncertain market, adaptability becomes critical. So active management allows us to shift exposures, manage risk, and focus on what's working while avoiding what isn't. And while diversification plays a big role in the overall performance, it doesn't mean you have to own everything. And let's look at the reasons behind the next slide. There's a big misconception, and we hear it all the time. And I think our industry has done the client an injustice in emphasizing diversification and not keeping your eggs all in one basket. It's prudent, and diversification is a big part of having steady performance, but it is a misconception because more holdings doesn't equal less risk. Not at all. In reality, over-diversification often leads to average returns. A concentrated portfolio of high-quality businesses can provide better control, clarity, and long-term results. Of course, when managed properly, and that's what we do. Now, let's consider another misconception when investing. Once you're in that preservation distribution stage, your income doesn't have to be derived solely by dividends and interests. In fact, relying solely on dividends can limit flexibility. A total return approach where you combine growth with selective income often leads to a better outcome over time. Growth stocks tend to invest their earnings back into their businesses. So instead of paying you income today, they aim to grow the value of the investment over time. That allows the investment to compound more efficiently and decide when to create cash flow by selling rather than receiving income randomly whenever, whether you need it or not. And now dividend stocks, don't get me wrong, they pay a regular income and it is more tangible for retirees, but it also means less control and sometimes less efficiency because you're receiving cash even when you don't need it. And so all these factors we just combined in a couple of slides, when implemented, makes the next slide easier to stomach. And we're talking about volatility. If you take one thing away today, I hope it's this. The goal is not to avoid volatility, but to survive it through quality selection, diversification across drivers, not just asset classes, and active decision making. We aim to smooth that journey. So we hear this all the time, and I know everybody knows this line, and it seems to fall on deaf ears many times, but time in the market matters more than timing the market. So let's go to the next slide. This is a compelling chart that tells you and reminds you of the cost of missing the best days of the year. If you're trying to, for those that think they can time the market, you look at missing the best day since 1990, you've lost about 3%. You've got a return of 6.1% versus 9.8%. And take the two best days, and you've got a 3% rate of return. That equates to a bond return. It's impossible to know exactly when these days are going to happen. But I can tell you they usually happen after the worst days of the market. So in most cases, investors are much better off staying in the market through periods of volatility. And this is where active management can play that role and keep you in the market longer. Let's look at the next slide, please. The next slide, Mike, thanks. So like a financial plan, it's important to position portfolios to address your specific investment style, your stage of the life cycle, I should say. And you've got 3 stages. And the right portfolio depends on where you sit in these 3 stages. In the early stage, accumulation, you're maximizing growth. You've got lots of time, and that heals any pain and volatility. Your dollar cost averaging as you continue to save and invest regularly. You've got the power of compounding growth. While when you're in the middle stage of life, you're balancing growth with risk control. You've got money now, and you need to keep it. And so risk management becomes that much more important. And in the later stage, where your preservation and drawing income, the priority is stability. You want income flexibility, and certainly downside protection becomes the overarching principle in your portfolios. But you still need growth, and now you need to manage risk as well, because it becomes a critical component in that stage of life, more so than the other 2, certainly. Sorry, yeah. Can we go back? So we have just gone through some of the upfront work required to get your affairs on track and meeting your defined objectives. A lot of this is the critical financial planning work that Mike and CDSPI provide their dentists. And only then can we really talk about investments. And we can go to the next slide. This is how Cumberland manages money. We focus on high quality businesses. We lean into sectors with durability, actively adjust risk, and build flexible income strategies, not rigid ones, because markets are dynamic. We've seen that over the last couple of years. And so why should you run a passive strategy in your portfolio? To us, it makes no sense. Let's look at the next slide. This is how the intricacies of our management style. We've got a team that considers a number of criteria in order to help make decisions and uncover any themes and opportunities to exploit. We look at the macroeconomic outlook. That gives us a sense of where interest rates are, the overall economy globally, that is. And then that will highlight where we want to be in terms of sectors that we want to weight and we want to expose the portfolio to. Then we send our analysts out to do all the fundamental work. We've got a proprietary scoring criteria that all we assume that when an analyst brings any idea to the table, that they've scrutinized these are passing our criteria essentially. And so from there, we could have maybe 100 companies to look at. We funnel that down into a very concentrated portfolio of 25 to 30 companies in all. And so it's very much involved, and that's all we do. So we can't sell you a credit card. We can't lend you money. We manage money. And if we don't do it right, we don't really have a business. So it's very important that we take the careful steps to make sure that we're optimizing the portfolio, we're protecting against risk, and we're keeping the portfolio in the highest quality we can. Let's look at the next slide, Mike. And this kind of brings it all together. It's a navigational process, and you need three things to work. Discipline, you've got to stay the course, especially when things get tough. You've got to stay the course. And a plan and a portfolio structure gives you the confidence to stay the course and withstand that volatility, because you understand what you own. You understand what your goals and objectives are. That's critical in investing and retirement planning. Quality, that withstands any volatility and gyrations in the market. High quality just gets you through most things, because, and by high quality, we mean companies that have predictable earnings, are at the top of their industry, have great cash flow and cash, and have very predictable earnings. Those are the companies that we can invest in with confidence. You look at Microsoft, Google, Amazon, for example. They survived the tech bubble of 2000. They came on and found iCloud. Now they're on the leading edge of AI. These are the companies that you can hold forever, because you've got the confidence that they know how to allocate capital, and that's critical. So you've got discipline, you've got quality, and of course you have to be adaptable. That's where active management comes in. You've got to respond to changes. And today, more than ever, with this uncertainty, if you were a client of ours, you would have seen a lot of activity over the last 4 to 6 months. And that activity was factoring in getting out of trouble and looking for repositioning the portfolio into the future. That's critical. And so let me show you some examples of how Cumberland adapts to changing environments and uncovers opportunity in the next slide. We're going backwards, Mike. Sorry. Yeah, thanks. So what you see here is this is a dislocation, which presents a very big buying opportunity as far as we're concerned, with better valuations. We've seen how tech, for example, when you look at the information technology, valuations were in the 30 some odd percentile, when the average is usually at around 20. The market's probably around 17 or 18. And they've dropped considerably, and yet their earnings continue to grow, as you see in the lines. The blue is the price to earnings multiple changes, and I'm sorry, I think that's green. I'm colorblind. It is the earnings growth. So this is a sector that continues to grow their earnings in a very rapid way, and yet it presents a very big buying opportunity because their valuations have come into more reasonable levels. And so while we have rotated out of reduced our weighting in Mag 7 towards the end of last year, we're coming back and revisiting them here today. So taking some profit, which was prudent in the last year. The Magnificent Seven, for example, were down about 18% in the lows of March, and today they're presenting fantastic value. Energy is the second best earnings growth potential, as you see on the far left of the chart. And we're selectively increasing our exposure there. So this is what volatility creates. That uncertainty has investors jumping ship, if you will, and somebody who knows the true value of these companies can step in and take advantage of that. And I think we've done a good job of that of late. So let's move on to the next slide, Mike, if you will. Yeah, what not to do. And that is the biggest mistake today that one can do, and that is reacting emotionally, trying to time exits and entries. It's a mug's game, frankly, and it often locks in losses and misses recoveries. Discipline matters more than ever, and I would say today especially. So let's look at the next slide. Just gone through some of the ideas. Mike's going to go through some positioning as well, but take a look at your own portfolio after having gone through some of these slides with us. And the question isn't whether markets will be volatile, because they will be. They are. The real question is your portfolio aligned with this stage of your life and built to handle this type of volatility? That's what you should be evaluating with us. If you found this presentation helpful and you'd like Mike and I to review your situation, contact Mike and we'd be happy to arrange a time. I'm going to end it there, Mike, and thank you everyone for your attention.
So, perfect. Let's move right along. And I want to, now that we've talked about markets, volatility, and a bit about some portfolio construction ideas, I wanted to shift into something very specific for incorporated dentists, and that's how to stabilize your plan and access some of your corporate wealth potentially more efficiently. Traditional fixed income, your GICs, your bonds, your high interest savings, of course, they obviously still have a role. But inside the corporation, that fixed income that provides the stability you're looking for, particularly in volatile times like right now, has a couple of disadvantages. Number one, it is highly taxed. That's probably the biggest disadvantages. And it's slow growing as well compared to what growth equities, dividends can do for you over the long run. And in some cases, it can actually hurt your small business deduction. So this section is about going beyond traditional fixed income and using tools that give you stability, predictability, and tax efficiency. So when I look at a typical dental career, the pattern's pretty familiar, right? You study hard, you build your skills, you set up your practice, pay off your debt, and eventually the practice matures and starts generating excess corporate revenue. And that's where the big question shows up. What do I do with this surplus? How do I manage it? Okay. How do I access it without giving half of it away in tax? This is the stage where planning definitely matters the most. So you really only have 5 places to put your money, okay? The big ones, of course, is a pension plan for those of you lucky enough to have one or maybe create one by means of an individual pension plan. You've got your RSPs, you've got your non-registered personal, you've got your non-registered corporate, you've got your TFSAs. And by the way, RSPs, I get questions asked about this a lot. RSPs, TFSAs, are they worth it compared to corporate investing? We're not going to get too much into that here, and I'll definitely take this offline if those of you have questions for it. But yes, they are worth it. It is definitely worth it to try and max out RSPs and TFSAs, extracting that money from your corporation and putting it in a tax efficient space, right? You're moving it from taxable as you go to a tax efficient space. Even in the case of a TFSA where you're not getting that immediate deduction, the years of tax sheltered growth will more than make up for the initial tax hit of pulling it out of your corporation to get it into TFSA in the first place. Okay, so beyond those registered plans, the TFSAs and the non-registered corporate, we've got one final kind of, I would say largely to this point, untapped territory, and that's insurance. Now, each of these has a different tax treatment. But for incorporated dentists, the corporate bucket is where the most of your wealth generally accumulates. And unfortunately, it's also where the tax drag is the highest. Interest income can be taxed at over 50%. Dividends and capital gains also face that same significant tax rate. It's just sometimes you're not paying tax on all of it. And this is why we need to be strategic. So here's how quickly the tax problem shows up. $1 million corporate portfolio earning 5% produces $50,000 of passive income. That's the threshold where small business deduction begins to erode. Okay. So if your corporation earns 7.5%, a really good year in the markets, that's $75,000 of passive income, 25,000 over the limit. The clawback is 5 times the excess. So at 5 times 25,000, you've lost 125,000. That means the small business rate, that nice 9% tax rate you get here in Manitoba, you're only able to earn that in the first $375,000 of active business income instead of 500,000. Doesn't take too long for that to get right down to zero. So it's kind of ironic that earning more inside the corporation can actually make you worse off from a tax perspective. So what do? Well, that's where insurance as an alternative asset class becomes incredibly powerful. It behaves like a fixed income asset, but without the tax drag. Okay, so what you get is tax deferred growth, a tax-free payout, immediate insurance protection, and stability during market downturns. And more importantly, none of the growth counts towards passive income loans. So instead of earning 1 to 2% after tax in a GIC, maybe a touch more in bonds, but with other risks added in, you're getting stable tax exempt compounding inside the policy at often much greater rates than you get from a GIC or even traditional bonds. Dentists often build significant wealth inside their corporations, but accessing that money personally can be very expensive. Salary is taxed heavily, so are dividends, and structures such as IPP or other pension structures can be complex to set up. A corporate insured retirement program, or CIRP, provides tax-efficient accumulation, access to capital, and a tax-free estate benefit. It's a clean, flexible way to turn corporate surplus into retirement income. The corporation purchases, so for the setup of this, how does this work? Okay. The corporation purchases a permanent life insurance policy. This creates tax-deferred growth inside the corporation while providing insurance protection. Just to give you a breakdown of how that works for those of you not too familiar with the whole permanent insurance concept. Unlike your traditional, say, term insurance that you might have got when you were just starting out, permanent insurance does not have a set window on it. It's something that you own for life, and it has 2 components to it. You have a death benefit, and then you have an investment account portion that the insurance company pays via means of dividends each year that you earn growth and interest on. So what your par insurance policy or participating whole life insurance policy starts out as is not what it's going to end up. It's actually going to grow over time. Okay. Now, you've purchased the insurance inside the corporation. So what's the next step? Okay. The cash value in that policy after its growth can be used as collateral for a line of credit. This gives you access to tax-efficient income without triggering taxable withdrawals from the policy itself. You're borrowing against something. The concept I like to use to illustrate it is if you're familiar with a reverse mortgage. You have a retiree who is, cash poor, but asset rich in that they have a house that's untapped. What they would do in that instance is they would take a loan against their house, the loan that they don't have to pay back while they still live in the house or are alive. And the interest just accumulates inside that loan. They get a cash payment. And then when the house is sold or when they pass away and the house is sold, the loan proceeds is paid off and the remainder goes to the individual. Okay, same concept for a loan against an insurance policy. You're borrowing against the cash value of that policy. You make no payments while the loan is in effect and while you're still alive. The loan is simply paid out when you pass away. So in the final stage, as I said, tax-free death benefit repays the loan. Any remaining death benefit flows through the capital dividend account. And by flowing through the capital dividend account, what I mean is that is coming not just out of the policy tax-free, it's actually going to your beneficiaries, your heirs, tax-free as well. It removes not only from the insurance policy, but out of the corporation as well, and goes directly into their hands. So you've accessed funds during life and still delivered tax efficient capital at death for what hasn't been used. The benefits are clear, okay? You get tax deferred growth, you're getting flexible access, no impact on passive income rules, a tax-free death benefit, and a CDA credit at death. It's one of the most efficient ways to turn corporate dollars into retirement income. So up to this point, we've talked about why traditional corporate investing can be efficient or inefficient and how insurance can solve that problem. Now let's talk about the opportunity, how we can actually improve on the strategies I just discussed. Split ownership takes the same core idea, tax efficient accumulation inside a policy, and adds a powerful enhancement. It's going to allow you to shift value from the corporation to you personally. So you're not just taking out a loan in the corporation's name, you're taking it out in your own personal name without triggering immediate tax. So instead of simply growing tax-deferred corporate assets, you're now creating a structure where the corporation funds the prescribed portion, you fund the cash value, and the cash value becomes a personal asset. This is how we go from good tax efficiency to great tax efficiency. Here's what the improvement looks like in real numbers. So let's say we have 3 million of corporate assets, and by putting it in this policy, we can convert this into $3.17 million of personal assets over 10 years. Or if we chose to wait, we can convert 2.48 million into $9 million over 30 years if we're looking at more of a deferred pension option. You're not just avoiding tax, you're rerouting corporate dollars into personal wealth far more efficiency than paying dividends or salary. Okay. Just keep in mind that personal tax rate you're going to pay when you pay it out of the corporation. If you, at first glance, you're saying 3 into 3.17, well, I can do better than that on my investments. But keep in mind, you have to earn a heck of a lot more than $3.17 million to get 3.17 million net out of your corporation. These numbers here, 3.17 million, that's net of taxes. That's the tax-free amount that's coming out. Same case under a strategy here where we have 9 million out over 30 years. Okay, so the structure, how does it work? The corporation funds the prescribed portion of the death benefit. You fund the residual death benefit and the cash value. The cash value becomes a personal asset. That's the key. You're shifting value from the corporation to you personally. At retirement, you borrow against the cash value. There are no guarantee fees, no out-of-pocket interest, no impact on your credit, and no collateral beyond the policy itself. The loan is repaid at death by the tax-free death benefit. So the case study shows the impact clearly, okay? I'm not going to get into every line item in this slide here, but here you have the cost to you as the individual and the after-tax income provided. So if you just do straight corporate accumulation, here is your after-tax income, where if you're doing the split ownership insurance structure, the after-tax income is actually much, much higher. Okay. As the years go on, the advantage actually compounds over time. The longer the strategy run, the more pronounced the benefit becomes. So this is why we say go beyond traditional fixed income. Traditional fixed income may be safe, but it's also not necessarily the most efficient inside a corporation. Insurance gives you that stability and tax efficiency at the same time if you were to consider it as a alternative fixed income asset class. So let's put it all together. A full strategy is to replace taxable fixed income with tax exempt insurance, use split dollar or CIRP to access corporate assets, protect your estate with a capital dividend account, and free up your investment portfolio to focus on growth. This is how you build resilience in your long term. And that last comment there about freeing up your investment portfolio to focus on growth is very much important. Number one, the traditional investments, because you're not going to replace your traditional investments with this. So if you're talking a traditional investment, such as say a portfolio that Gino would manage or existing portfolios that you have right now, that frees you to allow to go after those more tax efficient investments, the ones that are more growth focused, that may be a little bit more volatile. At times you may avoid volatility in terms of stocks, dividends, capital growth, things like that, because of uncertainty in the markets and a need for an anchor to your portfolio that you could draw an income from. Utilizing things such as the split dollar strategy says you have a tax efficient source to access income, and you can let the rest of your portfolio grow, and you don't have to worry about it as much during these volatile, turbulent times. Portfolio drops 10%. If you've got fixed income on a completely different scale off to the side in insurance that you can fall back on, that means you don't have to lose any sleep over that portfolio dropping in those tough and turbulent times. So it really can be a buoy for your whole portfolio, just to keep everything afloat and allow you to be more tax efficient and focus more on growth in the long term. Now, the strategy I went through today was just one possible strategy of income extraction. These same strategies can also be applied just purely as an estate benefit as well, as a ways to maximize your estate benefit, and in some cases create even more capital dividend account credit, so even more CDA credit, so more of your traditional investments can come out tax-free as well. There's a whole range of options with corporate insurance. It's just finding the right fit for you and what fits your solution. What is the minimum amount of insurance you can buy inside a corporation? So there's no set minimum for par insurance policies. I've seen par insurance policies for as little as $25,000 as a total benefit to ones as big as multiple millions of dollars. Now, for the strategy we talked about, for the income extraction strategy, there is generally a certain threshold you have to meet for it to be viable and worthwhile for that split dollar strategy, because it has certain costs to set up, etc. So you may find minimum thresholds depending on the strategy you're after. However, that's just one specific strategy utilizing that split dollar concept. If it's just purely an estate means, or just saying, hey, look, I want to have 10% of my portfolio in fixed income, and I'd like that fixed income to be, permanent insurance, then we can work with that number, whatever it is. So there's not a set minimum. It's just certain strategies may require a certain minimum to actually be viable, particularly when we're talking about a split dollar strategy or something like that. And in terms of ongoing costs for the CDA, I guess I would clarify what you mean by cost for that. The idea behind the CDA is by funding an insurance policy, insurance itself it creates CDA work. There's not a cost for you for that. So for those of you who have used your CDA credit in the past, it's basically taxes that have already been paid, or considered taxes already paid, for lack of a better way to explain that. So if you have a CDA credit, whatever that amount in the CDA credit is, says this amount you can take out of your corporation completely tax-free. So the CDA with an insurance policy is going to grow along with the total death benefit of that insurance policy. Now, where some of these strategies play in, such as utilizing a loan to borrow against your insurance, keep in mind the total insurance. Let's use an example here where you've got $5 million in total insurance by the time you pass away, and you borrowed $2 million of it to take out as income for yourself or for whatever means, just to take out of the policy. That means your CDA credit is still $5 million, but only 3 of it is used up by the insurance policy itself, because the other 2 million didn't get paid out, it paid off a loan. That means there's an additional $2 million that can be extracted from the corporation elsewhere, i.e. in the form of traditional investments, traditional portfolios you can have. So that's the great thing about things like this. Insurance isn't a one size fits all. Neither is Gino and Cumberland's portfolio. We really do try to tailor it to you and your specific needs. And there are lots of options out there. It's just about making sure you're aware that there are other options and exploring which one is right for you. So I want to thank everyone again for their time tonight, and we'll draw it to a close. But yes, thank you for attending, and have a great night.
Thank you.